According to a new report from Moody's, the number of companies who are entering the worst stage of distress has jumped more recently. In fact, it is at an 11-month high, but that's not even really the headline here. The headline from Moody's is that companies who own all that debt and who have borrowed all that debt are doing everything they possibly can to avoid bankruptcy. And the reason why is because just like in commercial real estate that we've seen over the last couple of years, and that one hasn't gone away, by the way, no one wants price discovery because price discovery would lead to a whole bunch of revaluations all across the board. And those revaluations are going to have to reflect economic fundamentals as they are and financial fundamentals as they are, not what everyone had hoped they would be when all of these deals went down. And as I mentioned, in commercial real estate too, we've got an update there. According to the latest bank statistics from the Federal Reserve, the banking sector has been retreating from commercial real estate ever since around March and April last year, when Mr. Van Metre and I told you about the inflection in the labor market that was going on. And those two things are related. In particular, they have a particular focus on getting away from construction and land development loans and slowing down their exposure to commercial real estate in the form of residential construction, apartment communities, and things like that. Again, it's the same principle. It's extend and pretend, because everything that was supposed to be good and positive, soft landing, low interest rates, economy that was growing relatively robustly, those things have not worked out. And so we are left with a huge imbalance in these credit markets where everybody has just said, let's sit here and freeze and hope that everything goes in the right direction. And along those lines, we actually have a couple of Federal Reserve officials, starting with Christopher Waller, who is actually starting to make a whole lot of sense where it comes to the economy. And that's never a good sign either. When Fed officials stop spouting the company line about how the labor market and everything else is strong and resilient and start saying, hey, we need to consider cutting rates here in July, that's also something to pay attention to, because it goes along with this deterioration in the credit market that is just hidden behind this wall of extend and pretend. So, Steve, I already mentioned it once here. Let's bring you in. I mean, Christopher Waller's making sense. Moody's is making sense, saying, hey, we're seeing deterioration in credit markets. The banking sector is very quietly agreeing with all that by saying we're cutting back our exposure to anything risky, at least anything outside of shadow banking, that is. Piling on tons of U.S. treasuries. It's basically a credit market story that is avoiding the fundamentals.
Yeah, Jeff, and let's talk about this private equity thing, because I don't think a lot of people really understand like what's happening and what the risk here is. Let's go back post financial crisis when we had a zero interest rate policy, and we could argue that it went on way too long, and there was a lot of just cheap money that companies could get a hold of. And so what happened is private equity companies just borrowed massive amounts of money, and they needed to make a return on it. So what they started doing is going out and buying companies. Now, they were being heralded as absolute geniuses, that if you had a business, Jeff, that was a family business for decades, and they would come in and just show you how to optimize it and run at a level that you couldn't even dream about. But in reality, what they were coming in doing, stripping out things like pensions, and they were coming in and borrowing massive amounts of money off that corporate balance sheet, and they were getting those companies to buy their stock back. And that was really the leverage there. Is you see these private equity firms come in, they look like brilliant geniuses, the stock would start going up, and then sometimes they would sell off the company. Now, what we see every once in a while, years and years later, is one of these companies will blow up. And what will happen is people are just in shock at how much debt these companies are sitting on, because nobody really had a clue. And that's the real issue here, is when we talk about extend and pretend, we talk about what's going on with Waller, we look at the stock market, and this thing really needs to keep going, because there's a lot of everyday companies that people have been buying these brands for decades, and they have no idea how much leverage is on the balance sheet. But when they go, you're going to see these companies just get obliterated, and it's going to start spooking investors that are going to start looking into what's going on a lot of other companies. And when they find out everybody's over leveraged, well, that's a huge problem that we don't want to have happen.
Yeah, that's kind of what Moody's was saying. Is once you get on this list of the lowest quality, the lowest tier of these ratings, the only way you really get off of it is for some kind of restructuring. Now, normally that's bankruptcy, because, bankruptcy is used to get rid of all the massive amounts of debt that Steve was just talking about. But that's what's unique about this period. In fact, like I said, it extends to more than just distressed companies and corporate debt and private equity. It just extends into commercial real estate. We are the antithesis of 2008. In 2008, everybody just sold to get the junk off their balance sheet, didn't care what the price was, didn't care what the systemic consequences were. And so everybody learned the lesson they took away from 2008, which was the wrong lesson, but it was one, at least a consistent lesson, was that, okay, maybe we shouldn't just sell it, just hit the sell button and get the hell out of everything before it really comes down. They realized that the systemic consequences ended up being worse. So the pendulum swung in the exact opposite direction. Now, when there's any problem in the credit markets, everybody's like, just, okay, let's just freeze everything here and just hope beyond hope that, the Fed or the economy or just something goes right, just sheer random luck. All of the financial characteristics that led to the bubble period and then the post-bubble period, somehow it all just works out in the end. This extend and pretend myth, though, as Steve pointed out, I mean, at some point it has to find some fundamental equilibrium where you can't kick the can down the road forever. And at some point there really is a reckoning. That's really the problem, is that nobody wants to see that happen right now. The lack of price discovery is the whole point here, is to keep prices from hitting the book, which is also an indication of exactly what Steve said. If market participants were at all confident that the fundamentals were moving in the right direction, or moving in their way, they would start to proceed with some of these workouts and work arrangements in the light of day, rather than just doing, what did Moody's to call it, these proposed exchanges or distressed exchanges, which are ways to avoid bankruptcy, which is the overriding factor that we see everywhere. So there isn't a whole lot of confidence in the space. Plus, when you have the macroeconomic fundamentals that are getting more questionable, not less questionable, you can see how the paths are moving closer and closer to colliding.
Yeah, Jeff, it's interesting. You talk about forgot how to grow economy, forgot how to grow a company. I mean, we're starting to see there's a lot of things that don't make sense. And hey, if asset prices aren't going the way you want, well, it's okay. You can just freeze them for a while now. As long as the stock market goes up, well, everything will just work itself out. And I think this is a huge problem, because you're right. There's some point that you can only kick this can down the road so far. Now, a lot of people want that. I mean, ask anybody who's invested in the stock market right now, said, do you really want price discovery? And the answer is, nope, I sure don't. And some people would say I do, because they think maybe prices are too low because everyone believes we're in a massive bull market and not a bubble. But the reality is, you think about these small and mid-sized regional banks that we're seeing on all this commercial real estate. Jeff, I thought that bubble was going to blow up, a couple of years ago, because it was so obvious. Hey, you've got a loan on a building. It's half occupied, and you're saying it's worth the same value it was fully occupied? Yeah, the math doesn't work out on that. But if you look at from the bank's perspective, look, if we were to revalue this at its correct value, we would be out of business. And I think that is something that a lot of American investors aren't ready to handle. I think Wall Street's not ready to handle. And I think there's this reality among Wall Street and certain investors that we know what the truth is. I just don't want to find out until I cashed out.
Yeah, that's the point, right? Is that everybody knows the losses are there. And as long as everyone has the same incentive is, if this thing goes bad and the price discovery happens and it's seen the light of day, it's problems for all of us. So the entire system has every incentive to not do anything. That's why it never blew up, is that it was sort of like this backdoor deal. I mean, it didn't really happen. It's not like everybody got in a boardroom and said this, but nobody needed to say a word. Everybody understood the stakes there. So it's just like, okay, we are going to do everything humanly possible to make sure that this stuff doesn't move. That, if you've got a loan that's coming due, then the bank is going to work out some way to keep it on their books at book value. We're going to keep your loan going, even if it have to rejigger some numbers here or there. We're going to do everything that we possibly can so that loan just gets locked in place. No, by the way, regulators are all on board with this. If you remember back in 2023, one of the things that the Federal Reserve, the FDIC, and the OCC, the triumvirate of bank regulating idiots, said, we want banks to work out loans. We don't want them to, we want them to have as much regulatory leeway as possible so that they can do these workarounds and change all the contracts as necessary, just to make sure that we don't have a wave of defaults and bankruptcies and foreclosures, and therefore negative price discovery hit the books. It's the same thing in private equity. Everybody knows the stakes. Everybody knows the game. And so there's every incentive to not have information, to not value everything as they are fundamentally. And so when you're living on extended pretend fantasy, you can make, the stock, you can make a number up. It's almost like, okay, this stuff is worth whatever everybody says it is, because there are no transactions to tell us otherwise. As long as nobody has any real reason to create that transaction, to have to sell, to go into bankruptcy, to have something liquidated, extended pretend can go on a long time. The key point is, though, it really only goes on so long as everybody believes that at the end of the road is that soft landing, the mythical recovery utopia that everybody's hoping for. That has to be a realistic possibility in order for everybody to stay shut up and silent.
Jeff, you brought up a great point about bankruptcy, because that's where you get price discovery. And while you were saying that, I was thinking about the Chinese property developers who, as things started to go bad with them over the last couple of years, they're like, oh, we don't want to go to bankruptcy. We do not want to go to bankruptcy. And some people said, yes, we do. And then they started looking, they're like, yeah, we don't want to go to bankruptcy here, because like you said, you go to an auction effectively, then you find out the true price, and next thing you know, everything gets revalued. So we talk about, Waller wanting to cut rates, and I think it's Kugler, she does not want to cut rates. But nevertheless, you mentioned the banking crisis, and it's really interesting because, we talk about monetary policy and how it doesn't work, but you realize something that really doesn't fix default. It doesn't fix, it can't even stop delinquencies in most cases, but you can't stop a wave of defaults. You can cut rates all you want. You can do all the QE you want, but unless someone's buying that asset at par value, it doesn't work at all. And that's the problem. And I think it's interesting looking back, what the Fed said is, look, we don't want this to happen. So as long as you said, everybody agrees, let's just figure out how to do this. The asset will stay at this level. Your loan will stay at this level, but the terms are all going to change. Then everything is fine. And at some point, Jeff, we both know that this can't go on forever. And that's the problem, because everybody wants it to go on forever.
Yeah, that's the big thing, right? It's always the contrarian take on that. It's like the most fragile system that you can imagine, but it looks robust from the outside, largely because it's given this gloss of fundamentals by the stock market, right? The stock market makes it look like the solid thing because stock prices are going up, including some for the stocks for these companies. Therefore, nothing bad can be hidden deep down in the bowels of these business balance sheets that nobody wants anybody to talk about or shed the light of day on. Now, you mentioned the Fed, and I've talked about that in the introduction. It's interesting how there's this growing, it's maybe not a majority in the FOMC, but there's this growing chorus of dissent. I mean, Christopher Waller just the last couple of days said, I'm probably going to dissent. Maybe the majority is going to vote for doing nothing in July, but I am recommending a rate cut here in July because what I see of the economic fundamentals, which does go along with all of this debt, the debt business that we're talking about here. He said, look, everybody took the payroll report, for example. The last payroll report, it was 147,000, was solid. Well, half of it was from teachers being hired in the public sector. The private sector don't look so good. In fact, one of the things that he said, a couple of quotes here, he said, looking across the soft and hard data, I get a picture of a labor market on edge. The private sector is not doing as well as everybody thinks it is. Most of the employment growth we saw last month was in the public sector, and that means the private sector is not doing well. So his whole idea, as he said on Bloomberg TV, the whole idea for me is get started, get ahead of things before it starts. If you wait until the labor market deteriorates, you're too late. It's over. And that's the point. I think you and I agree that the deterioration has already happened. It's already too late. And that's usually what ends up happening is the Federal Reserve is one of the last to finally figure this out. So here we have Christopher Waller, who suddenly starts making sense on the labor market, which to me suggests that, along with the beige book that just came out this week too, that some of the Fed starting to get very, very uncomfortable that the economic fundamentals have already shifted against them. And therefore, maybe they need to start, pretending that they're going to do something by cutting rates. The beige book was another big one because didn't mention inflation at all, talked about layoffs that were happening across industries. So I think Waller's position is one that's going to be shared more widely. Whether or not it happens in July or not is still an open question. I'm still kind of conflicted. I think there could be a July rate cut because of Waller's influence and the fact that this is really happening. But even the Fed is starting to see, okay, maybe we need to start changing our tune.
Yeah, and for good reason. Jeff, you talked about the non-farm payroll report, which is important, but there was one really key part to that I keep coming back to when I look at that report, and it wasn't the teacher jobs or any of that. It was the fact that average weekly hours for production and non-supervisory employees has now dropped to the second lowest level since the pandemic. So I look at that, and it's like, look, the reality is, yes, maybe the labor market's creating jobs. That's wonderful. But in the end of the day, those who do have a job are getting less hours. So even if inflation is benign or even going up slowly as we're seeing it, nevertheless, it still means the average worker is spending less money in the real economy, and that's going to backfeed. So we start to look around, and what do we see? Well, we found out from the Philly Fed this week in their banking and credit report that, yes, they said that delinquency rates have dropped slightly off their all-time high since the data series came out. But if you look at the other part of the report, it says that banks are running off more debt than they've ever had since the report ever came out. And I thought that was pretty interesting. And then I saw an interview from the head of the Port of Los Angeles, and he's saying, hey, you know what? There's a lot of front-running tariffs going on here that people don't realize. And he says, I think companies are making a real bad mistake. He goes, because they're taking their cash and they're borrowing money to buy as much inventory they can. And he's like, I'm worried it may not work out. Now, why would he say that? Well, it's pretty obvious, because he has people coming into work and he has got no hours for them, or very few hours. And that's the problem. And then you start looking at the delinquency rates, and then you start looking at broad speaking hours worked, and you start looking at the economy and say, wait a minute, this thing isn't going the right direction here. Do I think Waller's right? Does the Fed need to get ahead of it? Absolutely they do. Do I think it'll make a difference? Well, of course I don't. But Jeff, stocks might go up some more if they cut.
At least in the short run, because there's the narrative that stocks do well when interest rates are low, and that the Fed needs to be your friend for share prices to go up. But I think that what's really interesting about all of it is the interplay here. Getting back to something you said before about the rise of private equity, the private equity space in the wake of the 2008 crisis was in response to the fact that the rest of the financial system had been so destroyed and distorted by the crisis itself. Everybody was looking for what looked to be the best, most liquid, perceived to be safest outlet for what funds were available to be lent out. And so that wasn't going to be the mortgage market, which is tough, because the mortgage market is one of the biggest uses of credit that there is. So Wall Street is like, okay, we do have some funds that we can lend out. We're not going to lend into the real economy because the real economy sucks. And so they kind of went and said, well, we'll do all this financial rejiggering, and that will be the new subprime mortgages. That will be the new thing that looks really safe on the surface. And then it looked even safer as the stock market came back, really since 2013 and the latter half of the 2010s. And so it became this big kind of story, this big kind of workaround from the aftermath of the crisis. The one place that you could go where everything looked really good, really safe, really liquid, even though deep down inside of it, really was nothing more than financial rejiggering and recharacterizing these businesses. It was not fundamental purposes, and yet there has never been a reckoning or a shakeout in that space yet. There hasn't been one yet. You would think that would happen at some point. And with companies that are experiencing more and more trouble, in fact, as you said, Steve, those that are borrowing just for inventories, as soon as those inventory values start to go down, those loans start to go bad. I mean, it's the very definition of fragility that it's tough to make that point to the general public, because they've been told over and over how strong and resilient the system is, because it hasn't collapsed despite all of these problems that are underneath it. And I think that's the most interesting part of it, is that when you put all these things together in the context of the 2020s are saying, yeah, we had a little bit of a high there a couple of years ago, but now everything's coming down. And as much as we want to keep holding the price discovery at bay, at some point, you can't any longer. At some point, price discovery has to happen. And the closer we get to the downside in the economy, the closer we get to Christopher Waller convincing, Mary Daly and some of the holdouts like Jay Powell that this stuff is real, the closer the Fed gets to recognizing these weaknesses, the closer we get to the reckoning and all of this debt on top of it all.